Assalamualaikum warahmatullahi wabarakatuh. To start our presentation, I will introduce my teammates. So, my name is AFIQ bin SAZALI.
My name is HIDAYAH binti RAHIM.
Assalamualaikum warahmatullahi wabarakatuh. My name is Muhammad NURHAKIM bin SHAMSUDIN.
My name is NURSYAKILA binti KAMAL.
Hi, my name is MUTALIB bin AZMAN.
Hi, Assalamualaikum. My name is SYAHIR bin YAHYA.
The exact mix of debt and equity used to finance a company's assets and activities is referred to as capital structure. From a business perspective, equity is more expensive, long-term source of capital with more financial flexibility. Debt, on the other hand, is a less expensive, finite-to-maturity capital source that legally bind the corporation to predictable cash outflow and the needs to refinance at unknown costs at some point in the future. The capital structure of a firm is the consequence of this financing decision, which may be influenced by capital structure policy or target established by the management and the board of directors. The capital structure of a firm is also influenced by factors such as its size and maturity, which influence the financing alternative accessible to it.
I will present to you how to determine the optimal capital structure. But firstly, I will explain what is the optimal capital structure. The optimal capital structure of a firm is the best mix of debt and equity financing that maximizes a company's market value while minimizing its cost of capital. One way to optimize for the lowest cost mix of financing is to minimize the weighted average cost of capital, WACC. The lower the cost of the capitals, the higher the market value of the company. In the absence of tax, bankruptcy costs, agency costs, and asymmetry information, some economists believe that a firm's capital structure has no effect on its value in efficient market. Next, we proceed on how to determine the optimal capital structure. There are several techniques they use to determine the optimal capital structure. Firstly, the manager usually try to work within a range of values. They also must consider the signals that their financing decision send to the market. This technique is to avoid dilution and giving any bad signals to the market. A firm with good prospect will prefer to obtain cash using debt rather than shares. Announcements made about a company taking debt are typically seen as a positive news, which is known as debt signaling. The second technique is use of techniques such as thinking like a bank. What is the optimal level of debt a bank is willing to lend? Other debt ratios may be used by analysts to put the company into a credit profile using a bond rating. The default spread associated with a bond rating can then be used to calculate the spread above a AAA-rated company's risk-free rates. That's all from me.
So thank you Nur Hidayah. For the next topic, I will explain about effect, capital structure and capital structure decision. There are some of the main factors that affect capital structure, which is cash flow position and also profitability. Cash flow position is one of the factors influencing the company's capital structure. The corporation could generate cash flow through a capital arrangement. At that moment, the company's profitability is good, but not good enough to produce cash inflows to locate funds and meet obligations. To improve the company's financial position, forecasted cash flow should balance with agreed upon commitments. If the company fails to make a fixed payment, it may face failure or, in the worst case scenario, bankruptcy. So the next one, profitability. Profitability is always important in business. It is also a significant consideration when determining the capital structure. When a corporation considers return on investment (ROI), which considers the costs and benefits of debt financing. It may choose a rate of interest that is lower than ROI. When a company's ROI is low, on the other hand, the corporation must avoid going into debt. The next one, capital structure decision. There are three general categories, which includes internal factors, macroeconomic factors, and also general factors. Under internal factors, which is financial leverage. Financial leverage refers to the goal of fixed cost securities, which is to increase the return to equity shareholders. However, fixed cost securities also increase risk. If financial leverage should be used, it depends on how much risk the company is willing to face. Under macroeconomic factors is rate of interest. One of the most important factors impacting capital structure decision is the established market rate of interest. If the market interest rate is high, the company will choose to rely on equity rather than debt. Last but not least is general factors, which is size of the firm. The size of a company is one of the most important elements that influence capital structure decision. For a small business, it is preferable to raise cash through a sale of equity shares. As a rapidly growing firm, it is dependent on debt financing. So thank you so much. That's all from me. Thank you for listening. I'm gonna pass this presentation to the next presenter, which is AFIQ Daniel.
Thank you, Luqman, for your presentation, Ili. So I will continue our presentation to talk about financial distress. Financial distress occurs when a corporation is unable to satisfy or has difficulty meeting its financial obligation to its creditor due to high fixed costs, illiquid assets, or revenue that is sensitive to economic downturns. When a corporation is having trouble paying its creditor, it is in financial distress. Bankruptcy may be the result of the financial distress. The more debts a firm uses to fund its operation, the more likely it is to face financial distress. Bankruptcy costs, distressed asset sales, a higher cost of capital, indirect costs, and a conflict of interest are several costs that related to financial distress. Other costs associated with financial distress include high cost finance, product opportunity costs, and less productive staff. Employees in a distressed company typically have poorer morals and experience more stress as a result of the higher risk of bankruptcy, which could result in their termination. Next, I will talk about signs of financial distress. Firstly is poor sales growth or decline in revenues. When sales do increase despite aggressive promotion, it could mean a lack of client acceptance, which is crucial to any business success. Next is extended payment days. If a company has to postpone payment to its creditor, it may force certain suppliers to quit supplying them, as well as cause delays in production and service delivery, which can harm the reputation of that company. Besides that is difficulty in raising capital. If a firm is constantly borrowing and requesting for more funds from its investor, it is a sign that the firm is increasingly struggling in their financial. And finally is the defaulting on payment. This is regarded as an indication of business failure, indicating that the company is on the verge of insolvency or liquidation. Finally, I'm gonna talk about how to overcome financial distress. First is identify the cause of the financial crisis. Internal or external circumstances might cause it. Financial trouble are usually a sign of a large problem. As a result, long-term or permanent solutions are absolutely required to resolve the situation. Next is buckle down and remove non-essential costs. Companies should examine the company expenditure. They can find out where and how to cut expenditure from here. Find out which process costs the company most money. It's possible that these costs can be reduced. And finally, monitor the business cash flow. It's never been more crucial to keep track of the cash flow. This will assist the company in fully comprehending their company earnings and expenses. The company will be able to see the profit or loss as well as preventing the cash flow and which expenses can be eliminated. That's all for me. I'm gonna pass this presentation to the next presenter. Thank you.
Thank you, AFIQ. Okay, my name is NURSYAKILA and I will present about integration of tax effects and financial distress costs. There is a trade-off between the tax advantage of debt and the cost of financial distress. In the graph beside, we can see that as the present value of financial distress cost increases, so does present value of tax shield on debt also increases. As a consequence, we can understand how both are integrated with each other. The company can use the debt until its optimal point because it can increase the value of the firm due to the interest shields. Based on recent findings, the firm value increases when the company begins to shift from equity to debt. In this situation, the probability of distress is small because of the present value of minimal distress cost. Therefore, every time the value of a debt increases slightly, the present value of tax shield is increasing. At some, it will come equals the increase in tax shield present value. Here, bankruptcy will get increased rapidly from tax shield that will cause to decrease firm value. That's all from me and I pass to the next presenter. Thank you.
Thank you to NURSYAKILA. Assalamualaikum warahmatullahi wabarakatuh. My name is Muhammad SYAHIR bin YAHYA and my student ID is 2021480844. And today I'm going to present to you guys about the agency cost of equity. First of all, let me tell you guys the definition of the agency cost. So the agency cost refers to the cost incurred by the firm because of the problem that associated with the different interests of the management and the shareholder. Agency cost usually refers to the conflict between the shareholders and their company manager. For example, a shareholders want the managers to make a decision which would increase the share value, but the manager would prefer to expand their business and increase their salary, which may not necessarily increase the share value. They have three types of conflict involved in the agency cost. The first one is the conflict arise between the owners of the business and the managers. The second one is conflict arise between the owners. The third one is the conflict arise between the owners of the firm and its stakeholder. They have two types of the agency cost. The first one is agency cost of debt and the second one is the agency cost of equity. And I'm gonna tell you about the agency cost of equity. So the definition of the agency cost of equity is the agency cost of equity arise because of the difference in interest between the shareholders and the management. When the management diverge from the interest of the shareholder for any reason, the shareholder have to bear the cost. The agency cost of equity occur due to the suboptimal decision by the management and the cost incurred in monitoring the management to prevent them from taking this decision. Lastly is how to reduce the agency cost of equity. The first one, dividend payout reduce the ability of the managers to pursue wasteful activity. And the second one is that also reduce the ability of managers to pursue wasteful activity. That's all from me. Next, I'm going to pass to the next presenter, Abdul MUTALIB.
Thank you to Muhammad SYAHIR. Assalamualaikum warahmatullahi wabarakatuh. My name is Abdul MUTALIB bin AZMAN and I will explain about the pecking order theory. The pecking order theory, also known as the pecking order model, relates to the company capital structure, made popular by Stewart Myers and Nicholas Majluf in 1984. The theory states that manager follows a hierarchy when considering the sources of financing. This model states that the manager display the following preference of sources to fund investment opportunities. Firstly, by the internal financing, which is retained earning. Second, by external financing by issuing debt. And choosing equity financing as the last resort. Internal financing is the most easiest, the most cheapest, and the most convenient way in the sources of financing as there is no need any bankers involvement. The benefit of internal financing is the public can see how strong the company is because the company does not need any additional fund to finance itself. If the company could not finance itself, the financial manager will decide to use their external financing by issuing debt, either by selling bond or pledging their asset to raise the company loans. By issuing debt, the investor will see the company is confident enough to take the risk to meet their monthly obligation and encourage more investors to join them. Equity issuance will be the last choice of sources financing because it is the most expensive way compared to the internal financing and debt issuance. If the company finances itself through issuing new stock, it's normally a negative signal to the investor, as the company thinks its stock is overvalued and it seeks to make money prior to its shares price falling. That's all from me. I will pass to the next presenter. Thank you.
Thank you to Abdul Muttalib. It's me again, and now I'm gonna present to you guys about the signaling hypothesis. So the signaling hypothesis is the relationship between the dividend payment and the profit of the company. Signaling hypothesis also suggests when a company announcement of an increase in dividend payout is an indication of positive future prospect. So the hypothesis is based on the game theory notion, which state the managers with a good investment possibility are more inclined to signal when those without such as a prospect are less likely to do so. So if the company able to pay higher dividend, it means that the company also able to generate higher income or profit for the company. The higher dividend payment can be signal for the company to generate more profit or income for the company. Next, there is no discernible difference between the hypothesis that an increased dividend conveys a good news. The hypothesis that the dividend increase is a good news for investor. And a company that has a long history of increasing its dividend each year is indicating to the market that its management and board of directors are optimistic about the future profitability. The dividend are typically not increased unless the board is certain the cost can be sustained. That's all from me. Thank you.